these indicators aren't always correct, so always, take these with a grain of salt. But the expectation for this year-end rally just did not materialize. So a bit of a disappointing performance. But here's what you need to know before the bell this morning. Santa did not visit Broad and Wall over the holidays. And again, a little bit disappointing, but we did have a nice rally on Friday. They got us right back to the 50-day moving average, but that was below where we actually started the 7-day period. So we came up about 0.5% short on the Santa Rally. So Santa Rally failed. Now, what does that mean for the year? Well, typically when there's kind of a three-phase, kind of indicator cycle of this. So you have the Santa Claus Rally, the first 5 days of January, and then the full month of January. And that's typically your predictor for the year. Now, when you're just looking at the Santa Claus Rally, in years where you've had no Santa Claus Rally, market returns tend to be lower. A large percentage of the time. Now, not always. Again, we didn't have a Santa Claus Rally in 2023, and we had a boomer 20% plus year last year in the market. So these indicators aren't always correct. So always, take these with a grain of salt. But again, this is kind of, the expectation for this year-end rally just did not materialize. So a bit of a disappointing performance. We saw the market kind of peak mid-December and has really just kind of been rolling over ever since. And so we haven't really seen that pick up. Now this morning, futures are pointing higher. Dow's up about 137. S&P's up about 30 points this morning. So we'll hopefully get back above this 50-day moving average and start moving back towards that 6,000 level on the S&P. Now, if the markets can get above that, break above the above 6,000 here, then we'll try to retest these December highs. And that's going to be kind of the look for the month of January. So if we get the first 5 days of January to be positive, and that would also typically predict a full month to be positive, that typically leads to a fairly strong year in terms of the markets, about 10 to 12%. So again, if we're going to start getting some kind of bullish bias to the markets, it needs to kind of start here soon. Markets are oversold here. We're still on a momentum sell signal. Relative strength is decently oversold. So we're in a good setup here for a bit of a rally towards the January 20th inauguration. So the inauguration is on the 20th. That's when President Trump will take the oath of office. Markets tend, in presidential election years, markets tend to rally into that inauguration. So with markets oversold, we've got a good setup now for the markets to make this rally over the course of the next couple of weeks. Post-inaugurations, historically, markets tend to be weaker because, again, this is the first 100 days of office. We're going to immediately start seeing executive actions and these type of things. And so there's going to be some stuff that's going to potentially weigh on the market. So the market tends to be weaker in February and March. So again, a bit of a rally in the inauguration, maybe sell into that, rebalance portfolios, kind of position yourself for the new year. In particular because, again, expectations for this year are extremely elevated. Everybody's very, very bullish. And as Bob Farrell once said, when all experts agree, and they all agree right now, something else tends to happen. So use this rally here, kind of look at your portfolio, how much risk you're taking. Again, remember, we've had 2 very, very good years in the market. Don't keep taking excess risk, expecting years like the last 2 years to continue to repeat themselves. They don't historically, and you're typically kind of setting yourself up for some risk. So, I've got an article coming out tomorrow talking about Larry David and curb your expectations. Curb your expectations for this year. I think you'll be better off. That's what you need to know before the bell this morning.